Hello everyone, good morning. Welcome to COL's Mid-Year Market Outlook. I'm Charles Ang and I'll be hosting today's webinar. If I asked you, I'm sure a lot of you, if not all of you, would agree that the market so far has been a little underwhelming for the year. After rallying significantly in January, the markets has since corrected, reversing almost all of its gains actually at some point. If you look at the volumes, they also paint a similar picture, right? They've tanked recently with value turnover reaching its lowest levels in more than a decade. So this clearly reflects the general lack of interest that we're seeing in the markets today. Of course, you guys are the exception. You're here with us on a Saturday morning, very excited to learn more about the markets. And so for today, we hope to shed some light on how the second half could potentially look like. The last 2 weeks, we've seen a little bit of rally in the market. And so could this signal a more promising second half? Or do we see darker times ahead? These are the questions that we hope to answer in today's webinar. And ultimately, of course, we hope to help you guys capitalize on the market opportunities or the market weakness that we're seeing today. Our program flow for today would be as follows. So I'll just start off with the results of the investor sentiment survey. And then after that, we'll go to the main part of our program, which will be the fundamental and technical outlook, right? We'll be trying something a little different this time. And then, as always, we're ending with your questions in the panel discussion. Okay, so let me quickly go through. Oh, sorry. Before that, I'd like to remind everyone, okay, to send in your questions that you may have through the Zoom Q&A tab. And we'll try to take in as much as we can, of course, given the time that we have. But at the same time, we also have our analyst from the research team to help answer some of your questions. All right. So let's go to the results of our investor sentiment survey. So we asked you the following questions. You've probably seen these already. And so let's go to the next slide, please. Okay, so if you look at this slide, this one looks interesting to me. If you look at the overall bullishness or lack thereof of the markets that we're seeing today, what's interesting is that the overall percentage of people who answered either strong bull or weak bull, when asked what you think about the PSEI for the next 6 months, actually increased slightly, right? But if you look closely, at least this is how I interpret it, the number of people expecting a strong bull went down actually from 19% to 15%, and also the number of pessimistic views, which would be the weak bear or the strong bear, also increased from 7% to 11%. So the way I see this is that less the strong bull, more on the pessimistic side, and a lot more on the middle part of the graph. So a little, again, it's very subtle in my opinion, but I think it's reflective again of the general market weakness that we've seen the last few months. Going to the next slide. Okay, so the biggest concerns that you have would be the recession fears in the US and any potential weakness in the markets there, where we are certainly going to be discussing that in our discussion today. Okay, and then interestingly, okay, most of you answered your top consideration when choosing your investments. Most of you answered either the regular income or dividends is the one that you're trying to prioritize, which again, in my opinion, reflects a more defensive stance. Okay, a smaller part of you answered the high growth potential with high risk. Okay, and then this one also, 59% of you guys are currently invested in income-paying investments, which would be your bonds, REITs, or dividend stocks. Okay? Do we have one more? Okay, then yeah, this one is the last slide, of course. And this one is a little encouraging to me because a lot of you are still looking to add to your investments, meaning you haven't really lost all hope in the markets, right? But at the same time, it also tells me that there's still quite a lot of dry powder, right, in the markets today. So a lot of you are waiting for something, maybe a potential catalyst for the markets to sustainably go up. But yeah, we're all waiting for that to come. Okay, so maybe just to summarize the results, I think it's a little, it's subtle, but it still is consistent with the general, no interest in the markets that we're seeing today, right? But I think it's also evident that you guys, at least those who answered who participated in the survey, are still on the optimistic side that markets could improve in the next 6 months. Okay. So now moving on to the main part of our program. Okay. So I wanna invite our first expert. Okay. So of course to share with us her views, her fundamental views on the markets. So everyone, please welcome our Chief Equity Strategist, Ms. April Tan. Hi, April. Thank you as always for agreeing to share your knowledge, your wisdom with us.
Hi, Charles. Good morning. Okay. Thank you for your kind introduction, and also good morning to all our attendees today.
All right. So as I mentioned a while ago, we're going to try something a little bit different. So throughout the presentation, I'll be asking my questions. I'll be butting in to ask some questions to help the flow of the outlook. Okay. So I'm going to start right off with the first question. Okay. So April, at the start of the year, you mentioned that the Philippine market has what it takes to sustain its strong performance. So in fact, we were all expecting that the Philippines could continue to outperform the US market. However, the past 6 months has proved to be a little different than what we expected, right? So what went wrong?
Okay, so let me just share my screen. Yeah, so I think for the year to date, at least, the PSEI has significantly underperformed, being hardly changed. But you can notice during the start of the year, we were very strong, whereas the US looked like it was underperforming. But that has changed. And for the year to date period, the S&P 500 is up by around 19%, whereas the Philippines was, has languished after that strong January. And there are many reasons for that. Remember, one of the things we talked about in January was the strength of China, the excitement towards the reopening and what it meant. Unfortunately, that has been a big disappointment. Secondly, I remember one of the things that people were really excited about in January was expectations that the Fed would finally start cutting rates. In fact, the initial expectation was that rates would be, I guess, by the end of this year at the 4% level. But unfortunately, that did not happen. In fact, there is a stronger likelihood that the rate would be above the 5% level by the end of the year. And because of that, instead of the peso strengthening substantially, or say the dollar weakening, we saw the dollar remaining stable. And in some ways, that kind of encourages fund managers to stay with dollar stocks. And I think the final reason why investors are super excited about the US is because of the popularity of artificial intelligence, or AI, thanks to ChatGPT, which was launched in November and is one of the most popular apps right now. I think the major catalyst for that is the favorable earnings guidance of NVIDIA, saying that, hey, demand for our chips is so strong because so many companies need these chips to have AI as a functionality. So because of that, like US investors were thinking, maybe inflation is not going to be a problem because we have this productivity tool, etc. So yeah, I mean, those are many reasons why investors are, I would say, more optimistic on the US and more pessimistic, or they've ignored the Philippines. That's why we're just staying sideways.
So yeah, so it seems like they're prioritizing the US market for now, right? So it begs the question. So you mentioned a lot of change, right? So the question is, have you changed your mind about the Philippines outperforming potentially going forward?
Well, that said, I have not changed my mind. And let me just share with you why. Why I think the Philippines can still outperform the US. And there are many reasons. First of all, I'm not of the view that, or I don't agree with the consensus view that the US economy is no longer at risk of entering a recession. Therefore, there will be no more bear market. I think both are still possible outcomes. Secondly, I think the Philippines has better fundamentals compared to the US. I mean, the reason why we were positive in January, I mean, those factors are still there. And of course, valuations are still cheap and foreign investors are heavily underweight in Philippine stocks.
Okay, so let's focus first on the US side, no? Because I think with the with the recent rally in the US market, and a lot of people are already, or at least the consensus are already lowering their odds of a potential recession. So you're a little bit on the other side, non-consensus view, right? So could you explain what you think are the risks to the consensus bullish view of the US economy?
Yeah, okay. Yeah, so we try to look at what happens, what are the sequence of events that happen before a recession materializes in the US. And why is it taking so long? Because you think about it, since January, people were talking about a recession and investors were super bearish during the start of the year because they were anticipating a recession. But of course, it's not happening, right? Well, we did a study of the sequence of events that would lead to a recession. And I think the main conclusion is recessions recession is still a risk as rate hikes work with long and variable lags. Now, we looked at the Fed rate hike cycles since I would say 1950s, and we tried to study. I mean, since the 1950s, where every time the Fed increased interest rates, there were only 3 instances when there were no recessions. Okay, so I think it's the 1970s, 1980s, and 1995, no? But anyway, what we notice is what happens is first, inflation goes up. And of course, the Fed raises interest rates to control the inflation. And the only time when a recession did not happen was when the yield curve did not invert. Okay, every time the yield curve inverted, there always is a recession, or always was, implying that, oh, the Fed over-tightened, probably. That's why it led to a recession. Or maybe inflation was too sticky such that the Fed had to keep interest rates high to the point that, it tilted the economy into a recession. So anyway, so there you can see when the 2-year, 10-year yield spread inverts. Okay, so the inversion is shown here. No, every time it goes below 0, that implies an inversion. You will notice, no, every time that happens, a recession comes. So the recession is the gray shaded bar. So this time you can see that it is super inverted, similar to the 1970s. Okay. And I think this is important to point out. since the start of the yield curve inversion, how many months does it take for the recession to start? And you can see that that's why they always say rate hikes work with long and variable lags, because the shortest was 6 months, but the longest is 33 months. The average is 18 months. So for this time around, the inversion began, I think, some would say March, but then we chose July 2022 because that was, when it was like really sticky at the inversion. And you do the math, we're just maybe 12 to say 16 months. So yeah, if we're going to do 18, then, second half of this year or, early 2024, it can happen. Still within acceptable limits, in other words. And then, the other indicators, okay, so the Fed loves to use the unemployment rate. Okay, but, and it in some ways it makes sense. There's some logic to it because your unemployment rate has to go up for consumers not to spend. But if you look at this, unemployment is a lagging indicator. And again, the gray bars are times of recession. And you notice that usually the unemployment rate is the lowest, a few months before the start of a recession. Okay, so for us, that's not a very good indicator to look at. Instead, we look at other indicators that are the real leading indicators, like the US has 10 leading economic indicators. And this one, as you can see, is extremely negative. So every time it's negative, again, you have a recession, and now it's there. It's super negative. And again, another leading indicator would be the tightening of credit standards. Banks have clearly tightened their lending standards, and I think with the SVB, Silicon Valley Bank event or closure, they've tightened it even more because right now their banks are encountering liquidity problems, huge mark-to-market losses. So I don't think they have the appetite to lend aggressively right now. No, and then I think, for me, the biggest risk is never mind if US stocks are cheap because people are already pricing in the recession. Unfortunately, they are not, because as you can see here, if we look at the PE band of the S&P 500, the market is actually trading at a very high level in terms of PEs. So it's one standard deviation below the mean, meaning that, the risk reward is not very attractive.
Okay, so correct me if I'm wrong, April, but you're basically saying that because a lot of people are saying, okay, recession, we've been hearing the word recession for the last 12 months or so. So you're saying that the fact that it hasn't come yet at this point is just in line with historical lags, right? Now I mean, it's really normal to have that long of a lag between the rate hike cycle and the eventual inevitable, so far historically, recession. Is that correct, April?
Yes, that's what I mean.
Okay.
It's like parang boy who cried wolf eh.
Yeah.
It reaches a point where it's not gonna happen, then all of a sudden it happens,
Okay, so the next question is, okay, so let's say they enter a recession. Some people are then arguing what about the argument that, okay, when they enter a recession, the Fed would then cut rates and then it's going to be good for stocks. I mean, what's your view on that? I mean, how that impacts?
Yeah, we also took a look at that because that seems to be a very good argument. And unfortunately, history has shown, when there is a recession, of course, that would force the Fed to cut interest rates. And unfortunately, when they do that, the market doesn't go up. Because I think the focus now will be the earnings that are very weak, and that would matter more compared to the falling interest rates. So the focus shifts from interest rates to actual earnings of corporates. And by the way, I just want to highlight, for example, in the US, we're now actually seeing earnings on a year-on-year basis being down. I know that if you watch the news, they will say a big percentage of the companies are beating expectations. That's true. But the year-on-year change in earnings is negative. And for 2024, I think there is meat for the market to go down because the consensus expectation is that earnings next year would be up by around 10-11%.
Okay. So can you tie it all back to the Philippines? Because I've noticed so far we've been talking about the US market and the recession and the potential drop in the S&P. So how would the Philippines be affected? Just in case what you're saying is really gonna happen.
Yeah, I think, of course, my hope is that we will decouple. Unfortunately, I don't know what kind of of course, there's always a possibility that the US will not enter into a recession. We're just basing our concerns on what has happened historically. But, again, if history were to be our guide, unfortunately, every time the US, goes into a bear market, the Philippines is negatively affected. I think that is my main issue, which is why, even during the start of the year when we had our market outlook event, I was telling our investors, to keep some cash, some powder dry, so that if the market goes down, we'll have an opportunity to buy stocks at an even cheaper level.
All right. Okay, but I guess as a follow-up to that, then shouldn't we just, should we just, are you saying that we should just wait for that day to come? I mean, for the recession to hit, for the US recession to hit, not the Philippine recession, but the US recession, US goes down, sell off in the Philippines, and then should we then just buy? Or, I mean,
yeah, I think, that really is a very good question, because sometimes I can ask myself that as well. But there are many reasons why I think it would be wise to kind of get your feet wet early. First of all, because we don't know when the market will bottom, so it's kind of tough. And secondly, you can't get the volume. Okay, so I think now is a good time to talk about that. Okay, for example, we know that the past 2 weeks the market rebounded, and of course it was rebounding very strongly. Okay, so psychologically, I think it's very difficult for investors to actually catch that rebound and to get the size that they want. It is very frustrating to buy when the market is rebounding because the volumes right now are very thin. And if you look at the postings, you might have to buy up. And psychologically, I think it is very difficult. And secondly, when the market actually starts to recover, remember that the economic numbers are still going to be very bad. And I think there will be a lot of hesitation as well when you try to catch those recoveries. And because the volumes are so thin, the volatility is going to be very, very significant when prices are going up. And, there's no guarantee that you can get a better price.
Okay, so you mentioned earlier, a couple of slides ago, that you think that the Philippines has better fundamentals. So could you expound more on what you mean by that?
Okay, yeah. So I think the most important thing that may make the Philippines more attractive to foreign investors when, let's say, the US does enter into a recession and has a bear market is, they will again look at the Philippines and say, hey, this economy is a very domestically driven economy. As you can see, for example, in our 2022 GDP breakdown, domestic consumption is 73% of the economy. Okay, and net exports is negative 11%. So see, we're really not that dependent on foreign. So if you look at you go to Bloomberg, you look at the recession probabilities, the probability of a recession in the Philippines is probably 15%, no? Whereas the probability of a recession in the US, even now, given the very positive consensus view, is still at 65%. Okay. And that's because we are a domestically driven economy. And actually, if I look at the historical consumption growth drivers, such as OFW remittances, you look at it, OFW remittances during the first 5 months of the year still up by 3.1%, no? Still very healthy. And the IT BPM sector, or the BPO sector, which you would think would be vulnerable to what's happening in the US. Well, the thing is, companies are trying to cut costs. So what happens is they go to countries like the Philippines. So we don't have the 2023 numbers because they don't really disclose it. But if I look at another indicator, which has the number of square meters taken up by IT BPM companies, it was up by around 68%, according to Lichu Property Consultants. Another favorable thing is, like the rest of the world, inflation in the Philippines has already peaked. So I think our BSP is not as hawkish as the Fed because we already paused raising rates, even though the Fed increased interest rates, no? And the BSP actually cut bank reserve requirements starting in June 30, which from a signaling perspective is very favorable. They would say that this is actually this would have a neutral impact. But then again, I think if inflation were very high, the BSP wouldn't even cut the reserve requirements. And I think the main concern going forward, of course, is the interest rate differential. Because if the Fed continues to raise rates and then the BSP stays on hold, then the interest rate differential with the BSP and the Fed will diminish. And remember, last year, the peso depreciated to 59, no? Close to 60. But this time around, look, we decided around May that, hey, we're not going to follow what the Fed did, but the peso lately has remained strong. So I think this is good news because this gives the BSP room to, I would say, have policy independence compared to the Fed, no? And aside from that, I think this is a very important chart that our chairman, Mr. Lee, always shares with the clients. Where are we na ba in the grand scheme of things, in the stages of the market? I feel that we are already in the late stages of the bear market. So in other words, like most of the sell-off has already been done. Okay. And why do I say that? Well, first of all, valuations are so cheap. Look at that. We're almost retesting the 2020 low when people were scared because of the pandemic. When we had the lockdown, the initial lockdown, the Philippine market was sold down substantially. We're almost back at that level. I think we're at the 11 times PE level. And the foreign investors, I mean, this chart is since 2010. If you look at it, they've been selling consistently since the second half of 2019, to the point that, this is not a perfect chart, okay? But that said, maybe they've sold everything that they've bought since after the global financial crisis, and maybe some more. Showing how, they're already gone. They're super underweight in the Philippines. And finally, the value turnover has been diminishing. This is the rolling 3-month average daily value turnover. So you can see historically, it's always above 6 billion pesos. But now the rolling 3-month average is already below 6 billion pesos. So of course, if you are a client or if you are an investor in the market, you would notice how thin the volumes are. And probably if you were in the past logging onto your account every day, probably now you just check it once a week and probably you're trading a lot less. So these are some indications of lack of interest in the market.
Okay, So if I were to to summarize the last 20 minutes or so, because we've talked about a lot of things. So if I could just summarize, am I correct in saying that, okay, because of the last five or so slides, all of the the positive things about the Philippines, you're bullish, but the only issue is in the short term, investors are still prioritizing the US, and that's the first kumbaga concern that we have now. And the second one is that if and when the US does in fact enter into a recession, there might be a temporary contagion towards the Philippine market. But outside of those risks, you're really, I mean, we're setting up, or we have what it takes to to go up considerably. Is that a fair summary of what you've said?
Yeah, I think you've got it right that looks like I mean we were talking about this. If I look at the risk versus the reward, I think it's a good risk reward. Less risk versus potential rewards, because again, during this time of the market, potential upsides are very significant. I mean, it's during these times when you can buy stocks super cheap. And I think the fact that you're seeing a lot of companies actually privatizing is an indication of wow, like the insiders know that, I mean, our stocks are so cheap, might as well take it private, and, because we're going to make a lot of money eventually when, the tides turn. So, a lot of opportunities, but, on the other side, still not yet that clear. But if you have what it takes to hold on for a long period of time, then, now would be a good opportunity to actually be in the market.
All right. So given all that you've said, so what would your advice be for investors?
Okay, so anyway, yeah, I just want to talk about some risk, no? Baka maging sobrang bullish naman yung attendees natin, no? Yeah. So there are some domestic risks. Of course, we talked about the US market, but then okay, we talked about the long and variable lags. Again, we may see more of the first half where the recession is again delayed, and then Fed maintains high interest rates. The BSP might be forced to keep rates high. I think domestically, that said, some of the risk naman is that the second quarter GDP and earnings results might disappoint. And this is because, of course, we also suffered from high inflation in the first half, diba? And high interest rates. So because of that, baka the second quarter earnings and GDP might no longer be as good as they were in the first quarter and last year, diba? And then secondly, I think one thing that is worth monitoring in I think globally, not only in the Philippines, is that global warming, El Nino, and the impact this would have on inflation, and the Philippines, the tight power supply situation. So domestic inflation might be an issue, but this is more of discouraging, or not naman discouraging, but this would maybe delay any potential recovery of the markets. But okay. But anyway, so that's why my recommended strategy, I think this is something that I also shared in our first half economic briefing. It's still the same. I'm still conservative. I'm not yet saying, let's go all out and be aggressive and buy everything in the market. Still think that we should keep some cash. Preferred strategy is buy on dips, sell on rallies. The stocks aren't going to run away. I'm still very focused on value. I think value is very important. If stocks become expensive, I think it's good to take some profits. And again, the focus should be on the larger cap, more popular issues, because most likely they will be the first ones to go up. And again, if your stock would give you income or dividends, then that should be preferred. And I think a lot of our clients are doing that already. In the client survey, they said that they are preferring income dividends, REITs, yeah, and of course, in case a recession comes, we know that the Fed will be forced to cut rates, the PSP will follow suit, and that would be good for fixed income. And anyway, this is just to say, what do we mean by having some cash? So this is not, we are not recommending you to have this type of portfolio allocation, but this is for, sample purposes only. Let's say the standard portfolio is 60% stocks, 40% bonds. What we are recommending right now is for you to reallocate some of the funds that you used to have in stocks to cash, because there could be opportunities to buy at a cheaper price if we see some of these risks materializing.
All right. Okay. Yeah, so yeah, yung pinakahinihintay ng lahat, your stock picks. So could you share your stock picks?
Yeah. So yeah, these are our stock picks, and if you notice, they're basically the same. Those who follow our calling the shot stock pick list, we come out with them every time. I think the main difference this month compared to last month is that we removed Jollibee. Okay, and later on, I'll show you according to themes para medyo naintindihan nyo what was the thinking that I had when just recommending the same things. Well, first of all, one of the things we talked about is the falling interest rates. And who will benefit from falling interest rates? Well, the REITs would benefit, and our favorites are A REIT and C REIT. No, property companies would also benefit, and of course, Ayala Land is like the bluest of the blue. And Robinson's Land, the reason why we like Robinson's Land also is because I think around 40% of Robinson's Land's revenues actually come from malls. And right now, malls are beneficiaries of the reopening of the Philippines and the resiliency of consumer spending. And it's, again, we actually like SM Prime. The problem is it's not as cheap, but Robinson's Land is a much cheaper option, trading below book value. And I think single digit PEs. Let's look at this table. As you can see, single digit PE below book value. So that's really very cheap, and it provides you a 3% dividend yield, no? Okay, we also like power companies and telcos, okay, because power companies would give you much higher cash dividends, and telcos also would give high cash dividends of around 5 to 6%. Okay, then let's talk about the risk of potential GDP earnings disappointments in the second quarter. That's why we think also you should have a little bit of defensiveness, no? Which is why we're recommending, power companies or utility companies, and our top pick would be Aboitiz Power. And on the other hand, because we're worried nga of potential GDP and earnings disappointments, we think investors should take profits on, for example, Jollibee. We think Jollibee has gone up, has been one of the strong performers this year, and we think now is a good opportunity to take profits on that. Same goes for BPI and BDO. Those are, banks have done very well this year. And I think it's a good time to take profits on them, because those are close to our fair value, if not already there. If you want to still invest in banks, you still have Metro Bank, which is one of our recommendations here in the large cap value. And then those that are, if you want to take advantage of resilient consumer spending, those that are still trading at good valuations are SM, GT Cap, and Pure Gold. So anyway, I just want to talk about the potential earnings disappointments. Okay, as we discussed earlier on, one of the risks that we're seeing is El Nino and rising commodity prices. And of course, earlier on, we talked about inflation in the first half. So because of that, we're a little bit less bullish on consumer companies, especially consumer manufacturing companies.
Okay, so I just noticed, no, you mentioned, telcos, right? You're positive on telcos, but how come it's empty? I mean, what are your
Yeah.
thoughts on the specific names? Yes.
Oo. Kasi, the telco sector is, it's complicated. Because, okay, yeah, it's true that the dividends, okay, Globe and PLDT give you high cash dividends. Okay. So I know this is a busy slide, but we'll just talk about it. This is just a super summary because anyway, it's tough kasi pag inisa-isa pa natin eh. So both of them give good cash dividends, good income. But my main issue is right now I don't see much of a catalyst for both. So in some ways we want to recommend a stock where it's easy to sell to fund managers, or fund managers would be excited about buying it. And the thing is, parang hindi exciting yung mga stocks eh. For example, PLDT Globe, they give high cash dividends, but in terms of for example, the mobile phone industry, it's already mature. So very slow growth. And sometimes they even talk about inflation having a negative impact on subscriber top-ups. The last few years were very good for the telcos because of the fiber broadband business. Unfortunately, this segment is also maturing. Earlier on, like let's say a few months ago, people were very excited about Globe because they said, GCash would have an IPO. But then when we met with Globe, what they said that, they misquoted the president saying the GCash IPO. They said we don't need the money. And since valuations are kind of low right now, we're not gonna do an IPO. So they're just saying what our chairman is saying, or it means by saying we can do an IPO is, yeah, we're ready to do an IPO anytime, but we're not gonna do it, And yung PLDT naman, they have this issue about the budget overruns. We think it's really very cheap. The problem is, investors are a little bit worried at this point because of what happened, the budget overrun issue. For Converge, if I think about it, Converge has a possible catalyst in the prepaid broadband. That would be very interesting in the next few quarters. But right now, it's still early days. There could be some execution risk. And I don't think it will benefit from the search for yields or the falling interest rate because it does not pay any cash dividends. And then another interesting that we learned from the Lichu property consultant's briefing was that he talked about a possible overrun or possible oversupply of data centers. Okay, so one of the things we were thinking of that could be possible catalyst for, say, Globe or PLDT was that, the demand for data centers is going up because of AI. Diba? So they could be potential AI plays because of their data center business. The problem is, sabi ng Lichu property consultants, right now there is a potential oversupply of data centers in the Philippines because apparently the past few years there have been 39 companies, I think, that are in varying stages of putting up data centers. So there could be an oversupply here. And sabi niya, the second problem is, of course, we have a tight power supply situation. And we know that data centers are very power hungry. So where are they going to get the power to power up their data center? So that's another issue. Kaya parang walang catalyst in the near term.
I see. So yeah, so parang may kanya-kanya silang headwinds as of the moment. All right, so last question, April. How about the other power companies? So you mentioned bullish on power, but you only mentioned AP. What about like ASEN, FGen, even SCC?
Yeah. Okay. So yeah, ASEN is interesting. in the sense that first of all, it's a play on renewable energy, and we know naman that was uso, diba, in during the pandemic 2020, 2021, and that was the reason why it went up substantially, and then indeed it has a good long-term story. I mean, imagine right now its attributable capacity is around 4,000 megawatts. And it's on track to hit 6,480 to 2025. I think the 2030 plan initially was 10,000. I think now they've revised it even higher. And recurring profit growth is quite substantial. Okay, from 4.5 billion to 13.1 billion. That's a big growth. Okay, so this is the fastest growing power company in the Philippines. And finally, now we're seeing capital appreciation potential. So just recently, George Ching, who is our very conservative property analyst, upgraded it to a buy. I think the main thing to watch out for in ASEN is, the price of coal, the price of oil, no? So the reason why ASEN was popular before was, of course, you saw the prices of oil and other commodities go up before because of what's happening in Russia, etc. But now mababa siya. Okay, so I think for investors who are interested in ASEN, you have to look at the prices of commodities. I think the concern right now kasi is if the global economy goes into a recession, then maybe these commodity prices could stay weak also. So that said, baka wala pang catalyst for ASEN. Okay, so but anyway, for those who are interested in ASEN, I think you should look at yung mga coal and oil prices. And then FGen, this is also a play on clean energy naman, not renewables, because they're natural gas. So natural gas is not a renewable, but it's a clean energy. And then, but the difference is they have stable core operations. All their capacity is has a take or pay contract, and they own 46% of EDC, and EDC has 80% of its capacity with contracts. Okay, and right now there are, of course, the main issue facing First Gen is the depletion of the Balampaya gas field. But because right now there's a moratorium on new coal power plants, First Gen's LNG regasification project has become more feasible. No? And finally, valuations are very attractive. It's trading at 5.5 times PE, so very cheap. Capital appreciation potential 6.1%, dividend yield 3.5%. So, very attractive. But our main issue is, of course, it has a low free float of 11.7%. And right now, given the trend of companies taking advantage of cheap valuations to take their companies private, I mean, think about it. This company could potentially be taken private because of free float. You just take away 1.7% of the free float, then they might be forced to go private. So just risky on that respect, potential privatization. And then a while ago you talked about SCC. We did talk about it here, but I think we should view it similar to ASEN. Because if commodity prices go up, we have to remember that is a beneficiary because a big chunk of the earnings come from their coal exploration business. Yeah, but I think talking about commodities, I think the outlook for coal and oil is very positive. Going forward, maybe it's more of a 24, 25 story, but look at the commodity prices because the dollar is weakening. So I mean, we'll see. But yeah, if you see commodity prices going up, then SEC is another good candidate to buy. It has a good dividend yield. I was kind of surprised the dividend yield is actually 13%.
Yes.
So yeah, and then 3 times PE.
All right. Okay, so with that, I'd like to thank you again, April, for sharing your insights. Now, we'll see you in the Q&A segment, of course.
Yeah.
Okay.
Okay.
So thank you, April. So let's now move on to our second expert for today. Of course, everybody knows this one, right? So everyone, let's all welcome our Chief Technical Analyst, Mr. Juanis Barredo. Hi, Juanis.
Hello, Charles. Good morning, and good morning to all our viewers today.
So thank you for being with us on a Saturday morning, sir.
Anytime.
Okay, so I'd like to start off with your view earlier in the year. So could you remind us like what your outlook was back then and how, if any, has the technical outlook changed since then?
All right. Just give me a second to write my slides. All right. Charles, can I just check? Can you see the slides on my screen?
Yes, we can see it.
All right. All right. So we'll begin really with what we were looking at last time we met in the beginning of the year. If you can see that the slides you have in front of you, the chart of the PSEI back in January, we were having a very, very nice swing upwards. That generated quite a lot of positive sentiment, and everybody was really becoming quite bullish already. And during that time, if you notice the statement I put on top there was roughly what I was looking at. And I was saying that the PSE is on track to be able to follow its 2019 swing, but that January could actually lead up into a corrective consolidation. And if you were to look at what happened after that, and this is where we are roughly since then and today, and it seems to have lined up fairly well to what my expectation was. We went to a correction, then we started to consolidate, and we're currently inside that consolidation today. So I'm still quite hopeful, though, that that we may be able to punch through this consolidation sometime in the second half. I hope it's sooner rather than later, and continue to align itself with the target that I had in mind, roughly closer to 7.5, but that'd be a range between 7.1 and 7,500. Now, if you were to look at these charts that I have here, so I told you it was following track with the 2019 situation. And if you were to look at the chart on top, this is the 2019 chart of the PSEI. And at the time, I was already drawing out what happened then and potentially what happens after that, which is this one you see on the right side. And I've drawn up the Philippine situation here below to be able to reflect pretty much the same thing. If you notice the red line sign winding downwards, and then after finding a bit of a base in the second part of this, then a rally comes off. And that's what I'm hoping that we could still see attempt to be able to show off towards the second half of the year. And that could be quite an opening for some traders in order for it to be able to target next resistance. After 6,750, that would be something closer to 7,100. Now, another thing to be able to add to my context of why I'm keeping myself quite optimistic really is because I'm trying to be able to follow it on an Elliott wave cycle. And last time I actually showed these two charts as well, except for the one on the right side, which is a bit more fresh. And you've noticed that it's managed to be able to make a higher low back here on the wave 5 that it did, and we call this a truncated or shortened wave 5, which is supposed to be a bullish signal because it shows you it doesn't want to go all the way back down to the low that it did in 2020. And hopefully it just has to park here a little bit while longer before attempting to be able to wrestle itself upwards. In the shorter term Elliott cast, you would see that an ABC could have also been completed, although I may have to be able to factor in some risk. I'll show you a slide later that may have to be able to deal with that a little extension of a bearish situation just in case we do it. But if things prove to be quite good, as I'm expecting, we may just park here for a while and hopefully we can break above this area here, and that should be able to give us back some leeway into a rally space. Now, I'd like to go back to a chart. I think April showed this earlier to you. See, I told you April's starting to turn into a technician as well. And the good thing about this particular chart really is it helps us try to identify where we are in the cycle of things. This is called a bull and bear cycle map. And inside this map, you should be able to try to pinpoint where are you so that you can identify the range in that area so that you can adjust what your strategy to the market will be. The important question here is to ask, what do you sense in today's sentiment? What are people feeling around you? That way you can locate yourself somewhere into this map. So you ask yourself, there's two positions which we could actually be in, because there are two major bottoms inside a major bear market. The first one is this one. But this bottom here normally is generated by panic coming right after people are being quite fearful of the market. I don't seem to be sensing any conditions of desperation right now. And I would agree also with April that I think we are in this segment of that bearish map. And given so, I can see the no interest. There's a lot of pessimism. People still talking about recession. People still talking about slowdown because of high interest rates. People are doubtful of what the equities market can do for them. So it seems to align very well to this condition we have here. Now, but the reason why this is important is, remember this: if this map is a cycle, the end of this is the beginning of this, what you have on the left side. And that means the end of a bear market would line up with the beginning of a bull market. And so keep that in mind when you're looking at the way things are right now. So you should really be looking to gradually position yourself already into the next swing activity, because I think majority of the bearish trend has already been factored in with the market. And that's something that a lot of people have to be able to consider.
Okay. So Juanis, correct me if I'm wrong. So basically what you're saying is that despite the general market weakness over the past 6 months, which has left investors feeling a lack of interest, you're saying that it's still setting up, the Philippines still setting up for that bottoming out process, or that reversal process that you've mentioned as early as January this year. Is that correct, sir?
Yes, sir. That's correct, Charles, because bottoming out is not something you do in a day. Right, you have to be able to build a good foundation of accumulated interest into the market. Now, it cannot run away from us because, like April pointed out, there are a lot of headwinds still there. Interest rates are still relatively high. That is a direct competitor to our equities market. So as long as rates stay high and we still have some headwinds and potential recession, perhaps in the US, people are not going to be all out aggressive. But what they will do is they will take advantage of that short-term situation, capitalize on that opportunity today, because prices are not going to be here too long.
All right. Okay, very clear. So in the earlier discussion with April, so we talked about the importance of the global markets, even the interest rates, global interest rates, and the dollar on the PSEI. So could you share your views on these global factors?
All right, sure. So I think it's necessary to point out that we pointed this trend out back in January, that we said that inflation levels are starting to taper. That was very clear in the US at that time, not yet in the Philippines. But clearly, as of several months down the road, I think where you can see in the inflation chart in the Philippines, we're pointing quite well on the downside with the last 5.4%. The US doing something like almost 3% in their last tag. So I'm still seeing a clear evidence that inflation is very much already under control. Although I think some central banks still want to make sure that we're not going to see any sudden surprises in this later. And that's a reason why they don't want to turn rates around. And they're going to probably just keep it where it is for the meantime until they can make themselves sure that inflation is controlled. In fact, when you look at the chart here on the right side, I'm showing you US bond yields as compared to Philippine bond yields in the bottom. Just recently, we had a little bit of an uptick into the bond yield market in the US and even the Philippines. And that was a bit worrisome, and that caused some volatility in both our markets, because there was a play again that the US may still raise rates maybe one or two more times before the year ends. Although I think that could just be posturing. Yields right now, they did make a rally, but they fell back right away. So I think I would only get worried if I see yields climb back up maybe above 4.10%. That would probably be something I don't think the market had factored in yet. But right now it seems to have cut down on its brief rally. The Philippine scenario, the same. Yields have also gone from 675 back down to 628. So again, it seems to be quite well taken care of in terms of any risk threat from that going up. So I think this would be quite contributory to the fact that it should put some added bullish back into our market gradually. In terms of the dollar and the peso, just recently also, we saw that the dollar broke down from an area pattern. That means significant weakness into the dollar. And although I think it fell down a bit too fast, I think it could use a little bit of a rally, maybe rally closer to maybe 101.50 or 102 on the DXY. But I don't think this would go all the way back up here. I think it will just make maybe a half distance recovery and stay generally weaker. And if you were to look at the peso dollar here on the right side, we also had a breakdown on this particular event showing you that the peso did become stronger. And right now, it could also have a little bit of rally, maybe seeing resistance between 55 and 55.30. But maybe after that, maybe just keep itself relatively strong and inside this consolidation band above S1 or above S2. So I would picture that also as a bullish call for us because the attractiveness of your currency should be able to help keep investment amounts well placed into our market. Now, I'll go a little bit in the US because I think right now, to me, this is about the only significant risk that I would see, excuse me, as an interim condition, but I am quite bullish on the US. And the reason for that is, again, I'm also using a template that I borrowed also in history. This was what we call the dot-com bust. And during this particular market, it went through a heavy corrective phase for a few years and then punched out, and then it just went up, up and away. And just recently, this is the S&P currently in the bottom. You could see a relatively close affinity to what you see above. And it also went through a breakout condition of the downtrend it's had for about a year. And then just strike up. Momentum seems to be quite strong on the way up. However, we are dealing with some overbought conditions. So although a market can be overbought, that doesn't mean that it's finished and it will not climb anymore. All it has to do is fix the overbought condition by maybe parking sideways or maybe retracing a little bit, going back to a level that seems to be a little bit more supported in price, and then it can resuscitate its advance. And so far, I see no topping out conditions being shown to me on the technicals. In fact, a position in terms of correction could be something similar to what you saw here. It could just consolidate a little bit on the downside, pull back a bit, maybe 5-7%, and then after that you might be able to see it resuscitate itself. So I would still see this as another bullish call later on after the correction is done also for other markets. And if you were to look at the situation from other markets as well, I would say a generous amount of other markets are also doing fairly well. I mean, Europe is on the way up, although yes, it could do a little bit of a correction. So is France, Spain, and England, the same condition. If you were to look Japan was one of the strongest markets we've also seen, including markets like India. And of course, here in the upper right-hand side, you have Indonesia, which also looks relatively well after correcting, managed to be able to jump up inside. And India, South Korea, Taiwan, and Singapore are also aligned with that type of relatively stronger formation. And those that are relatively trying to get out of this bout of weakness are obviously China, which is one of the weaker ones. Philippines, I'd still put this in here because we're still in consolidation, and others like Hong Kong, Thailand, and Malaysia. But one thing is I can see that some of these, even here in the bottom ones, are already trying to work themselves higher. So I guess the only ones I see under threat right now is China, maybe Hong Kong, Thailand. The rest look relatively good to me. So I don't really see too much threat, except for just in case China does something wayward into a downside because of the economic struggles that it currently has. And finally, in terms of commodities, I guess I would add some tempering here, because in terms of commodities, gold prices corrected from the very, very strong movement. Even with the dollar falling down the way it is, gold only managed to rally a little bit. So it's not showing too much instability with how currencies are going to be showing. So that's good. Second, if you look at oil prices here in the bottom, it's trying to make a recovery because of the weakness we're seeing into the dollar. but I think it might be capped. I don't think that will probably break above 80 or 84 as a potential rally for oil. So I think it probably stay below that area, given it's still into a downtrend. If you were to look at the charts of nickel and coal, though, a little upsetting because it shows us that the state of demand for these commodities are still not very good. So I don't see this being a benefit, because that's kind of telling that people are probably quite defensive into these particular things for the meantime. So, but other than that, I don't see any negative things that might affect us too heavily, that might condition us to continue on downwards, except, of course, maybe a lingering of rates going higher. And if, let's say, a situation that Abe was talking about, and that if we do see some sort of recession and something that could be something more than what many of people are expecting, that's about the only surprise that we may have to deal with.
Okay, so Juanis, in light of those risks that you just mentioned now, no, so how would you reconcile that or translate that to the local market, right? To your views on the local market.
Okay, so let's try to put that together. So in terms of the US technicals, it's still strong, but they're stretched. So all we're talking about is maybe short-term correction for the US. So not so bad. In terms of yields and interest rates, okay, I mean, right now, admittedly, that is the headwind, right? We're seeing rates may stay high longer, and that is a direct competitor to us. And because of that, I think right now that's going to be a situation that we have to keep our eye on. If that does not adjust downwards soon, it might have its potential effect into the economy, and that might be a headwind that might throw us into whack. In terms of the dollar peso, it looks favorable to us, so I would see more bullishness in that. That's why I mark it off as a green. And in terms of commodities, I would say neutral. Some are okay, some are not, but I don't see too heavy threats right now. So in terms of these things affecting the Philippine market, if you were to look at the Philippine technicals, they're better than what they were a couple of months ago. That's a first good signal I've seen. They did not break support in the last attempt to try to do that. We were on the verge of doing it, but we managed to rally. Second good signal. The third signal we need to see is a breakout over 6,750. Until that happens, we're sideways. So right now, I'll stay neutral until that fact takes place. But if that fact hopefully is around the corner, then I think I would see a bit more intensified action into the local market.
All right. So Juanis, you mentioned a while ago that you are on the optimistic side,
yeah.
But is there a risk on the other side naman? What's the likelihood of that happening?
Yeah, okay. So anyway, I'm a prepared slide for that, because I had a lot of people asking me about the potential of this happening, just in case something, a monkey wrench is thrown in and disrupts things. So let's look at things the way they are today. So here's an example of what the index looks like. We're stuck in a sideways range. What I'm looking for potentially is this. I'm seeing that after an ABC scenario, which is an Elliott corrective wave, a truncated one, a shortened one, that tells you that resilience in the markets here and that the potential for it to recover may be there. This might be able to push us over the 6,750 and target the next level of 7,1, hopefully a little bit more. And I think that we probably have greater chances of seeing this into the short term coming towards this second half. Okay, so what happens if the Fed comes up, starts to talk up their nature that, no, I'm still going to raise rates one more time, maybe even maybe two more times. Or let's say that inflation starts to pick up and that, again, throws people into the defensive, then that means that certain things can happen. Or let's say there's an escalation of conflict somewhere that can threaten supply problems and re-escalate inflation as well. So the scenario for that would be that instead of seeing an ABC here end, you might be seeing that this could be the A wave, this entire consolidation be a B wave, and then one more final correction wave as a C, and that be the end of everything. And after that, the market comes out, creates a base, and manages to be able to recoup already from that consolidation. But if I were to put, let's say, a percentage chance, I'd say 80% chance of scenario one here and 20% chance of scenario two as a potential. But one thing I'd like everybody to be able to keep their eye on, aside from that bull bear market chart that we showed earlier on, is you have to understand, where are you closer to making a market high, or are you closer to making a market low? You have to ask that question, because as you're going to be positioning yourself into this, you have to know, should I be looking to hold my positions already or pick up more little by little as things reinforce themselves? Or should I just continue to unload because you think that there could be immense downside yet? I don't think that second situation is up, because we today are in a bear market heading towards a market bottom, if not already. And given that context, this is the PSEI chart that I've shown you since 1987. Every time we have a market bottom inside, the market has always managed to be able to make a rally back and make a new high given that condition. Here, another bear market, made a low here, rallied back, went higher than the previous high. Another bear swing here, went up really, really strongly back to 8,800. And now hopefully seeing this cup-like situation, whatever we see as a bottoming out area, I think later on we'll see the market come back and beat that 8,800 high. So I think that itself is good reason for us to prepare to position into this market as we come and see the tail end of this bear market come out and fulfill itself.
All right, so definitely some, some exciting things that you said there. I'm sure some of our audience got excited about the 80%, 80-20, the 80-20 probability. So that's definitely exciting for me. So having said that, Juanis, what would your advice be for traders?
Okay. In terms of traders, let's look at it this way. There's two positions here. I want you to be a hunter and gatherer at this stage. And the reason that means I don't want you to just go buy anything. You have to still be quite selective. Remember, we're stuck in a range. Given a range, you're going to see some issues rallying. You're going to see some issues continuing to go down, because that's what happens. That's what creates a sideways push. So as long as our index stays above 6.4, 6.30 support, I think it's okay for you to be able to look for your favorite stocks, see if they're holding above key levels, particularly if you can see that they're already climbing over your 100-day EMA. I think those are all good signals that they've established good levels of support and that the potential for them to rally are already very much in place. The reason I want you to be selective, I think April also pointed this out earlier, is because we're coming from a situation where a market has no activity, no interest, low volumes. And in such cases, you cannot afford to chase prices up. So I want you to buy them as they pull themselves off support. That is very important, because if you chase a rally, fizzles out, it could take a long time before you'd see them come back, and that might threaten your ability to stay there. So it has to be very selective, and you have to be very considerate with what you're doing. You have to be a stock picker here. 6,750 is the range to break. So if that starts to break, I think you can increase your intensification process here. You can widen your berth in terms of the issues. I would look for pullbacks from support right now from stronger stocks, those that are on uptrends above the 100-day EMAs. You could also do some range trading if the patterns are wide, but if they're very thin, I think you just stay away and just wait for breakouts to take place from them later. You can try what is known as a mean reversion trade. That means if a stock price falls down very, very sharply, and this is one of the popular issues, well traded, the minute you see them in oversold conditions, you can try buying that so that they can try to rally back to the next resistance. That's a potential trade. And the third one is a bit more patient. If you see companies that are falling down to major lows, they're making consolidation bases, and breakouts from these bases could be an opportunity for you guys to buy that for a worthy rally back into the next resistance as well. I can talk a little bit more about some of those demonstrations of those patterns later when we start showing some of the issues that I'm keeping watch of. But again, keep note that markets could run up only for a while because the volumes are thin, and this can continue to be a market risk because momentum in the market is very, very light, if at all anyway. So please don't chase prices.
All right, I think that's clear. So Juanis, could you share some of the sectors that you prefer, and maybe even the specific trading setups that you think traders should be looking at?
Okay. So in terms of the sectors, I think it's very clear. It's no doubt that the banking sector is the strongest. It was the first to rally. It stayed up there. It hardly makes any correction. So clearly the demand is flowing in that direction. The market feels quite secure there. That tells me there will be continued action into that sector. So I think there should be bank positions into your portfolio. The only thing is wait for prices to come down, especially because in the last few days, we've had some intensification moves. Like I said, don't chase the price. So wait for them to come back to support before you buy them. Then there are holdings and commercial companies as a sector that also look decent. Services selectively, not all of them. So I would think that's why I color them in orange, because that's relatively neutral. You'll probably see pockets of activity there, not as clear as the banking sector. But in these particular things, I think you can make some selective movements. Later, when I discuss certain picks, I would show you how to be able to tell a strong one compared to a neutral one and compared to those that are just trying to bottom out and what you have to do for each one of those things. Now, the weakest are obviously the property and the mining sectors. Right now, I guess they're waiting for more catalysts to be able to come out. In terms of property, I feel that high interest rates are very much a direct competitor to its ability to generate better business. And I think April pointed out that it's only really if we see the potential for rates to start to subside that perhaps there could be some movement back into this sector, but it might be a laggard. In terms of mining, right now, since demand is still relatively questionable, they're going to correction. I haven't seen it base just yet. There could be a rally in oil, but that's so much all what I see so far. So I think rallies into this sector will also be tapered and limited. So maybe sell first into a rally for these ones and then maybe buy it when it comes back down to support, at least for the sectoral conditions. Okay, Charles.
For the trading setup, sir.
Oh, okay. So I would break my setups into three categories. Primarily the first one for the stronger trend issues. So when you see stocks that are already trading over their 100-day moving average, these are the categories, and this is what you're should be doing given this context. So here you might be able to see some pocket price surges push up because you can see there's already been intensification. But wait for pullbacks to the 20 or 50-day moving average before you start picking this up. I would like it better if you see that MACDs are cooperating, that they're no longer negative and they're pointing upwards. This is one way for you to filter that your stock has better momentum and it'll probably have more lasting power into the upside. I should feel quite confident buying these on pullbacks because that would just be temporary setbacks and you'll probably get them moving up. So I'll give you some examples of this when I show some stock prices later. And I would also agree with April. She said take some profits into those rallies. Yes, I think you should do that. But when I say take some profits, don't sell all, right? I'd like you to keep yourself positioned because we're coming from a basing maneuver here. So you just sell a part of what you have, and in whatever you raise as a proceed on that sale, you're going to look to buy that back into the dips, into support. And here you might be able to have some breakouts that could have some few days follow through. The problem here is some others that are weak. You see a breakout, it breaks out for one day, goes back into the pattern, and that's very typical into a bear market. So you can only follow breakouts on stronger trending stocks. So don't apply that to everything that breaks out. Second, you might have the ability for range trades into those that are in clear area patterns. Or if you see, like I said earlier, you see a sudden drop, it goes to an oversold level, you might want to buy that for a counter rally swing. That's one way for you to also make money into this kind of situations. Now, mind you, as I go to the right, in terms of the formations involved, it becomes harder and harder because you're trading against the trend. On the right side, we're talking about buying stocks in a downtrend still, so it might be very difficult. But for those in ranges, it's a quick buy, a quick sell, right? You're range trading items that have clear support and resistance areas. Sometimes the rallies here may not go all the way up to the high. It might go only a midway to the high. And that's common also because remember, the market is weak and still trying to be able to regain its footing. So oversold conditions you can take advantage of, but remember, you're buying that quickly and you're selling it right away. Here, breakouts often fail because remember, they're ranged. So it might seem to break out. Next thing you know, they're back into the pattern within 1 or 2 days. So that's a common instance for especially these types. Finally, we have those that are the issues that have been falling down for a while. Now, I know a lot of people say, wow, you know, they fell down so much already. It looks like so cheap. Why don't we go ahead and buy? Yes, that could be an argument. But remember, it could take 1 or 2 or 3 successive lows before that situation will allow it to make the rally that you're talking about. So to try to put some safeguard here, wait for patterns to form. So it'll fall down, then they'll generate a consolidation sideways, and inside that consolidation, you see them uptick from there, then you can pick it up. At least you know that there's substantial support given the fact that they've generated the pattern. So these are the basing attempts that you can try to buy into these declines. But again, like I said, just remember, if I were to allocate my volumes and trading capacities here, majority will be on the first one, maybe with the second one being the next. The third one, I will control how much activity I will put into this. And this is the way I think the trading styles will still be in a very much mixed market.
Okay, thank you, sir. And also, I really like this slide because this really emphasizes the need for, you know, for the rules, for the discipline, especially when given today's market environment. So despite Juanis's optimism, again, there's still some headwinds, guys, and we still need to exercise discipline and caution and selectiveness whenever we're doing our trading. Right. So I guess this is a good parang summary of your view so far, diba, that we've talked about. Okay. Okay, Juanis, could you share some of the, can we now go to the specific stocks that you, or issues that you think have a good setup?
Okay, so we'll go into the slides. I've broken these down as demonstrations of the 3 columns that I presented earlier on. So here, let's start with those that are clearly uptrend buys and our options to look for pullbacks. Here are very, very strong issues that we have. For example, the likes of BDO, Bloomberry, Meralco, and Jollibee. Remember, these are technical points of view. I understand that April just took out Jollibee, perhaps because of the recent stretch in price. So my standing here is, as long as uptrends remain, I will just watch these issues carefully for an opportunity to buy them again. So in the case of BDO, we had a breakout situation, pulled back for a couple of days, pushed back up to a new fresh high. So clearly the opportunity continues and remains here. But again, since you've gone up 2 or 3 days, again, I would rather wait to buy this on the way down as prices come closer to these supportive areas. You know, if we can even get them back to 135 to 132, I've identified more prime areas to buy. But anything between your 20 and 50 day, or this orange and red line you see here, these are viable areas to be able to enter. Just again, please avoid the chasing of prices, because we're not in that environment that is a runaway just yet. Maybe if your index breaks over 6,750, that could change. Meralco, the same. It's now into a channel. So again, wait for pullbacks. I pulled back the other day. I hope we can just do that a little bit more. For those, like I said, when you can take some profits, do not sell everything. You're in an uptrend, you have to try to stay with that uptrend as long as possible. So when you take some profits, maybe you can take 20 to 30%, maybe maximum 50. And that way you do have some cash to be able to use, to be able to buy back when that comes back to our supportive areas. Bloomberry, also very strong, but this could be a beneficiary of the fact that just in case MPI moves to delist, it could be a number 1 or number 2 candidate to be able to swap it into the index. And I think this is the reason why people are playing around with the movements right now, but the technicals still look relatively decent. It just broken through several highs. So hold this or wait for a buy into a pullback, or if you're getting closer to the red line you see up here, that might be take a little profits first and then wait for a buyback later. And the same conditions for Jollibee. I think it's just a bit too extended right now. I drew this red line here because there's a previous high in history. Wait for this to be able to settle down, maybe closer to these areas, 244 to 238. These would be more prime areas for you to buy. In these areas, maybe take a little profits, like I said, 20, 30%, and then just wait for the pullback. So this is what I would put majority of my activity in stocks doing things like this. In this situation, you see all of them are trading above most of their moving average, if not the 100, like I stated earlier on. Now, there are still a lot of issues that are in a side-winding situation. They've not come back to a new high, or they've flattened into consolidation. I think you can see clear examples of that here. For example, GT Cap still has to be able to target its previous high. Ayala Land, this is an example of a mean reversion after falling down very, very sharply into oversold conditions. Now it's making a counter rally, and I'm thinking it'll encounter resistance maybe closer to about 2750, maybe closer to 2980. There could be some hurdles here, so maybe here take some profit, wait for it to come back down to support, and then look for a potential repurchase there. Also, remember, Ayala Land is a sector that's in the property, so I would be extremely surprised if we're going to see continuing up moves in this. So take advantage of this when you have it. ICT, very clear flat area pattern here, rally to the mid zone area, trying to break out. If it can, then maybe it can probably retarget 220. But maybe if it's up there, take some profits and then wait for prices to come down again. And Manila Water is another example. You can see a channel being involved. It's currently somewhere closer to the mid-zone area. If it punches over 19, then maybe it can retarget the next high band, which is closer to about 2070 or 2080. Again, range trade this particular thing and buy it closer to the support areas that you have between 18, which is the low here, and 17, the low closer to the channel. Okay, now this one's, I recommend this to those who perhaps have a little bit more experience, because remember, you're trying to be able to move in very early to a potential reversal condition. And so you can clearly see some of them are downtrends. There are downtrend lines that are breaking. For example, in Monde, in Globe, you already see that. But in the case of Semirara, DNL, I mean, downtrends are still very much in place. But there are area patterns for us to be quite happy about, because that tells you that they're anchored themselves, just like you see in Monde and just like you see in Globe. So I think there is a potential to make this trade. Again, my volume activity here should be a bit narrow than what I would have in the first two types, but participate nevertheless, because if they do break, they could have an initial surge that will provide you an opportunity to make short-term money here. And who knows, maybe they could intensify later and go to the next phase and become either a sideways or uptrend. And you might as well have some positions on it right now after these major bases inside. So take your cue from the patterns. If they don't have a pattern, you just see a single straight line going down and there are no patterns yet, that means please stay away for the meantime, because they have not been able to groom themselves or anchor themselves well in order to generate a worthy rally for yourself. You might see a little bounce, but it'll be very small, non-lasting, and you might even see them come back to the previous low, if not lower. So please be very careful. Do not trade downtrends unless you can see clear evidence that people have been accumulating them into these patterns. And I think that would be a very important thing to do if you're taking a bit more of these dangerous attempts to buy basing type of formations.
Okay, I know that we're running a little bit behind schedule, but I just need to ask one last thing, Juanis. So
okay, sure.
What happens when we break out of 6,750? What would change?
Yeah, so what changes it? The market might intensify. You'll probably see a little bit more broader number of issues attempt to partake now into the rally. The target zone will be 7,100 to 7,500. So you have some space to make money into that call. But I think more as a optimistic person would be the third sign I was telling you that would confirm that the market's getting ready to bottom. Right, and that means that even if it goes to 7.1 or 7.5 and it backs off from there, that would still be a buying opportunity for us. I hope that would coincide with the US making a correction so that while we correct, they correct at the same time. And after the US finishes its correction, we finish our correction as well. And we can both start to trend up as well, given that context. But clearly that is a prime scenario that I would really like to happen, the break of that 6,750.
All right, so thank you for all your insights, Juanis. Of course, I'd like to invite you again to our the Q&A segment. No, but before that, again, just to remind everyone, if you have questions, feel free to ask them. We'll be answering them right after we go to our advanced questions. Okay, so for the advanced questions, we got over 100 questions. So I tried to focus on the questions which we think are most relevant to the most number of people. So all right, so can we have April back? Is April here before we get to the okay? Hi April.
Hi.
Okay, so let's now go to the first advanced question. Okay, so AI, yeah. So the common talking points of the markets today. So AI first. What are your thoughts on the positive or negative effects of AI to the Philippine market? So April, you want to start with this one?
Yeah, I think I think there are concerns that AI would lead to job losses in the BPO sector, no? But right now we're not seeing it yet. Fortunately, we are not seeing it yet. No, it probably is a few years away, if ever it will. On the positive side, we were initially looking for potential plays on AI, and we were thinking initially of the data centers of the telcos. Unfortunately, when we're talking to them, parang hindi. And yun na nga, when we attended that talk of Lichu Property Consultants, they're saying that the main issue with data centers right now in the Philippines is the tight power supply situation. Because before you can run your data centers efficiently, you need a lot of power. So parang unfortunately, the Philippines is not poised to benefit, but on the positive side, we're also not affected by it yet right now.
All right. Okay. I think we can take on the next one. Okay. On the Maharlika Fund, how will the Maharlika Fund affect stock prices? So this was asked by Romel and two others. So favorable, will it be favorable or not?
Yeah.
Right,
I think I don't think the funds will be used to invest in stocks. At least those that are listed right now. Well, I still need to look at more details, but parang sa near term, I don't think it will benefit the domestic stock market. We still have to look at the details. Most likely those will be in new projects, no? Okay. So maybe it's a longer term impact, not in the short term.
Yeah, so not in the short term and not directly to any particular issue. Okay, that's clear. Okay, next slide, please. Okay, on global factors. Okay, so we have quite a few here. So first one would be on the de-dollarization and the impact on the markets, right? So April, do you wanna take this first, or and then maybe Juanis can share his views on the dollar? Yeah.
De-dollarization. Okay. It seems scary, no? But that said, there are several reasons why de-dollarization will not happen. At least in the near term, maybe not even in our lifetimes, because notwithstanding all the things that are happening in the US, and the thing is, what alternatives do you have to the US dollar as a reserve currency? So your potential candidates would be potentially the euro, the Chinese yuan. But then, okay, the issue with, say, the yuan is, between the dollar and the yuan, which is a lesser evil, no? So, and then you can't really convert to your currency to yuan right away because it's very much a controlled currency. So that's a major issue. So yun yung mga possible candidates. Now, the euro has always been a potential candidate to the US dollar ever since it was formed. But how many years later, it still has not. No, the benefits of the US dollar is first, the liquidity. If you want to buy dollars, you can buy a lot of it right away, right? And then, of course, you can easily invest in it. You can do so many things with it. You can place it, easily place, diba? And then you can buy so many assets with it. You can do so many derivatives with it. You cannot do the same thing with any other currency, which is why, people talk a lot about, all the other currencies. Well, yeah, they're going to have a bigger role, but to the point where the dollar will no longer be the world reserve currency is not going to happen right away. Because the other currencies are not ready. They don't have what the US dollar has. So yeah, unfortunately, well, fortunately and unfortunately, the dollar will looks like it will remain the world reserve currency in the next few years, or maybe even in our lifetimes.
Okay, so it seems like the concerns are a little bit over exaggerated at this point. Okay,
Yeah.
so Sir Juanis, before you answer, so I'd like to highlight kasi the questions on the left side. I think the slides are got a little mixed up. So I'd like to highlight the questions on the left instead. So before you answer your thoughts on the dollar, so I'd just like to read. So will our peso continue to strengthen against the dollar? And maybe if you could get your year-end projection of the dollar to the peso. So do we have something?
I think in terms of the first question, I think the Philippine currency has been showing that it had remained relatively stable, if not stronger than the dollar in recent months. And I don't see why that would change so much. Although I think they will try to be able to move together. So in other words, if we see right now that the dollar manages to make a little bit of a rally, the peso dollar will also make a little bit of a rally. Now, how much of the rally might be a bit more contained? So I'm thinking in terms of the peso dollar rate, I'm thinking something between 55.50 as a rally high, so 55.30 as a rally high, not much more than that. So I hope that we'll probably see that the peso dollar rate will close below that at the end of the year.
Yeah, and that's good though, because historically, is it correct, sir, that PSEI performs well when the peso is also appreciating, or at least not depreciating?
It helps, not all the time, but it helps, yes.
Okay. And then the second question here. So effects of elevated US and Philippine 10-year rate, does it prevent the PSEI? So do we need to see the interest rates go down before the PSEI could materially rally, or is it not a necessity?
I think you want to see the yields go down first because they normally move in advance. The rate itself might take its time to be able to be adjusted. To me, it's more important to see perspective of what people are anticipating because your market is trying to do the same. It's adjusting itself with regards to what it perceives may be the upcoming move. And that, to me, is what I'm using to be able to create my bias. So it doesn't seem like yields are going to push up over this recent high that we just saw. Given that context, they don't seem to be worried about interest rates climbing up more, if not maybe just staying sideways and maybe waiting for a rate cut maybe down the road in a year or who knows after how much, maybe sometime next year.
April, do you want to add?
Yeah, can I add to that? Because one of the reasons right now why investors are not interested in stocks is because they're getting good yields in fixed income. Okay. So that's why you really need the bond yields to go down so that if you can't get your returns from fixed income, then you'll think about taking on more risks, such as buying stocks. No. So that's that's the reason why these interest rates are very important. And again, why is US important? Also, it's because to some extent, Philippine yields are held hostage because of US yields. If the US yields are high, then of course Philippine yields have to be higher. Otherwise, it will be more attractive for investors to keep their money in US dollar and US dollar assets.
All right. So guys, that's very clear. Continue to monitor the 10-year levels. Okay, next slide, please. On the Philippine outlook. So are we still seeing a bear market trend, or is it already turning bull market into a bull market? So, Juanis, your thoughts on this?
We're still in a bearish trend. I guess it really banks on the 6,750 and 7,100 breaking. I mean, that's where you can probably start to change your view. But I hope you understand that. Remember, markets move ahead in reality. Okay, so you're probably wondering, how can the Philippine index look like this or look better while all these bearish things are still there? Well, that's normal. I mean, normally market will move first because people who are buying today are looking for investment to the next year or two, not for what's happening right now. Right. So keep that in mind, because I don't want that to detract you, that if you see, oh, here we go, we get a break from these key resistance zones, and you say, but we're still in a bear market, so I'm not going to buy. So I think you have to reconcile that first.
Okay, April, do you want to answer the next one? So if the Philippine growth story is intact, why are investors ignoring it? I think this is more or less the gist of your presentation a while ago, but so if you could summarize, so why are they ignoring the Philippines?
Yeah, I know. Unfortunately, there isn't any urgency because, I mean, think about it. If you're a foreign fund managers, I think one of the major issues is the foreign funds aren't coming back in. Okay, if you're a foreign fund manager and the US market is doing well, and you're not in it, then may career risk eh, 'di ba? Whereas in the Philippines, yeah, it's okay. I mean, think about it. In January, people were the foreign fund managers who were surveyed said, Asia looks very attractive. First of all, there's China. And then, of course, ASEAN, the governments are a lot more disciplined. Then valuations are cheaper. So very positive. But the fact remains that, the US market is going up. And secondly, you have AI. So it's the sexy story, unfortunately. The Philippine story isn't sexy. It's okay. Companies are growing, but they're not growing in an exciting way. And then the market is just small. So there's no urgency. They don't need to rush. Diba? I mean, it's just human nature. I mean, think about it. You might think, well, Juanis and April have been saying, looks like market's cheap, look like things are going, medyo bullish, medyo ano. But doesn't mean that you're gonna buy stocks tomorrow, right? Because the market isn't going up. But the moment the market starts going up, people are just gonna rush in and start buying stocks, So it's just the same thing.
All right, so I think that's a very good segue to our next slide. So you kept on talking about urgency. So I guess the question, this is, I guess, the one of the more commonly asked questions. Also from Donald and 5 other clients, customers. What could be the major catalyst to make, I guess, to drive the PSEI up?
Yeah.
April,
Okay, so ako yan.
Yes, it's.
I think okay. I was looking at Juanis' presentation for the first time, and I think in his scenario, parang in the next 6 months it could go up, diba? He's saying that's his 80% scenario, 20% it could go down. Okay, so I kind of reflected. So what if the US market continues to go up? can the Philippines go up? I think my answer is yes, it can. But if you ask me what will be the major catalyst that will allow foreign investors to finally say, okay, we're done with the US. We don't want to invest there anymore, and we're kasi okay, to just put context into my answer. During the start of the year, diba, we talked about how foreign investors were saying we're bullish on foreign markets, because they're cheaper, their governments are more disciplined, etc. And then, of course, what happens? They still don't invest in Asia. They don't invest in the Philippines because the US goes down. So I think, once and for all, for them to put money where their mouth is, we need to see the US recession really materialize, and actually, for the US market to go down, so that, okay, so what they've been anticipating will happen in the US actually happens, and for them to actually deploy money to Asia. So if you ask me what is the major catalyst that is needed for any recovery in the Philippines to be more sustainable, I think that is what is required.
Okay, so it's really unfortunately, we're really dependent in a way on like foreign funds, right? Because even when we talk to some of the local, the funds, they're also not in a rush to buy, right? So everybody's like
We're
waiting for
waiting,
everyone else. Yes. Juanis, do you want to add anything on like on your side?
Well, in terms of the catalyst, of course, I think number one catalyst would be, can we actually see rates start to simmer? Because that itself can release quite a number of funds, right? I heard another analyst the other day talking about the potential delisting of MPI, and where will all the investors go after those? They're raising, I don't know how many billion that they will raise from that. Where could that be also re-injected back? Who knows? That could also be a catalyst. Anything that could add inflows to us will clearly be a benefit to the market.
It might happen that the valuations right now might just reach a point wherein it's too attractive to ignore, and you see all these delisting or privatization efforts, which would at least even indirectly lift asset prices.
Yes,
Okay.
but that would require other markets to continue to climb up, so that by comparison, we look much cheaper than the rest. And that's when it's too hard to ignore.
Yeah. All right. Okay. So next set of questions, please. Okay. What are the primary criteria to consider in choosing the best stocks? Okay. So it doesn't have to be per industry, per company, but I guess what criteria are you looking at? Let's say we can start with Juanis, for example. First, what criteria should we be looking at when choosing stocks during a market reversal?
That sounds more like a technical question. So I think I presented the elements to that. If you're looking for a potential bottom, make sure they have ranges in the bottom or patterns in the bottom that can anchor prices well. I think that's very important. Second, I would want the prices to go over at least the 50-day, if not the 100-day EMA, to tell me already that it's done its reversal, gave me that confirmation so that I could see much more better upsides from there. Anything lower than that would just be in an up and down movement inside a weak market. So I think those two have to be hand in hand.
Okay. April, do you wanna like in general, like right now, you mentioned a while ago you were preferring like defensives and the large caps. I mean, do you want to add anything like during these moments of market reversal? What
I think I think compelling stories, earnings that prove a story that I guess to make it easier for people to understand. For example, this year, the best performing sector is financials. And why is that? first of all, there was a pandemic and people were worried about asset quality deterioration. And we saw from the earnings of the banks that didn't materialize. Okay. And then when the market, when the economy recovered, we're seeing a recovery in loan demand. Interest rates are going up. They're okay because they have a lot of low-cost deposits and their margins are in fact improving. So, if you have stories like that, na okay, parang it's all blue skies. That helps. That helps cement the leadership, which is why the banks performed very well. But right now, I think yung power, that's another sector that looks quite good because, for example, the supply situation is really very tight. No? So yeah, that's more favorable for that sector rather than the others.
All right. So I think the next question is for you, April. So given the market standing today, so is peso cost averaging still okay to apply? And as a challenge question, what type of stock and percentage of return could they maybe expect from doing so?
Yeah, I think, peso cost averaging is actually very good. But okay, I think, first of all, because the market is trending lower, and if you do peso cost averaging, your average cost also goes down. Okay? Kasi, 'di ba? So, okay, not trending lower, but sideways tayo, bottoming out process. Okay. So that would help you, I guess, first of all, get a better price. Secondly, psychologically, it might be very difficult if you buy all at once, then the volatility is there. At least when you do peso cost averaging, it's very affordable and you can accumulate more stock. So yeah, it takes the emotions away from,
Yes.
being, kasi I'm too heavy, baka maging emotionally affected ka, di ba? So at least when you do it slowly, it's something that you can do easier. So what type of stock? Well, personally, I think it's better if you don't have a lot of money, you should just buy indices or a fund through, say, an index fund so that it's automatically diversified, especially if it's a small amount, rather than just sticking to one particular stock. And if you insist on buying a stock, probably stick to mga blue chip stocks on doing peso cost averaging, because at least, when the market goes up, it would go up faster rather than the smaller cap illiquid stocks, no? Percentage return per annum, we really don't know. That's very difficult to determine. But historically, I mean, it has been shown that equities outperform naman the other asset classes.
If I may add, April, no? So add on to what you said, because I often explain EIP or the peso cost averaging as a volatility or risk management tool rather than a yield enhancer, di ba? Parang it's a risk management, as you said, makes it easier, makes it less emotional, makes it an easier decision, right? So of course you still need markets to go up for you to make money, and di ba? And so it's probably just going to be in line with the market, but the advantage is that you don't get to be, you won't get scared of volatilities, you won't have to try to time the market and so on. And I guess one other thing, what's interesting that you mentioned is that because people often equate the EIP or peso cost averaging to individual stocks, and you explain that you could definitely also do so for index funds. So EIP on index funds, which basically diversifies your portfolio already. Okay, Juanis, do you want to add anything on peso cost averaging or?
No, I think I agree with both what you guys said. That's fine.
All right. Okay. So let's go to the next one. I think now we're focusing more on specific sectors. Okay. So take on the property sector. I think this is one of the most asked sector. No? So April, do you want to start before I get to Juanis?
Yeah. Okay, so yeah, on the property sector, I guess the question is, why is it so weak? Well, first of all, high interest rates are not good for properties in general. And secondly, but the property sector is suffering from two issues. The first issue is the office leasing sector is suffering from oversupply. Okay. What were the issues that brought about this oversupply? Well, of course, prior to the pandemic, we had the POGOs all coming in and requiring aggressive amounts of office space. But then now POGOs have left, and well, they are coming back again, but they're coming back in trickles, not in the same magnitude that they were. So the companies who before the pandemic had planned to build all these office space are completing them little by little. Therefore, you have an oversupply situation in the office segment. And because of that, of course, we know the rental rates have a downward pressure. So that is one of the issues. And the second issue is the residential sector. So because of the pandemic, again, the momentum on say condominium sales has diminished. Okay, and although so right now the strategy of the property developers is that they will make the purchases more affordable to the buyers. They'll give you easy payment terms, but then 80% is due by say the turnover, which is say 5 years down the road. The thing is, what happens is a lot of people who were lured by these affordable payment terms cannot get a housing loan. Okay, so maraming cancellations. So those are the two issues. But that said, I think there are some silver lining. Okay, first of all, for the office sector, I think as I've discussed, the demand is coming back. And although supply is still exceeding demand, I think the projection is by next year, all that excess supply will be taken up already, because at least demand is still there. Demand is not drying up. On the property development sector, well, the demand is still there. It is picking up. So at least I think we've seen the worst in terms of the cancellation. So yeah, some recovery already taking place. And of course, if interest rates go down, then I think at least, that should help lead to the recovery of the volumes. And finally, valuations are crazy cheap, like below book value, single digit PE. So yeah, I think it's priced in.
All right. So that's clear. So interest rates pa rin talaga would be the catalyst, but at least some silver linings already. Juanis, I guess maybe because you already mentioned a while ago that properties segment has been lagging, right, as a sector. I guess if I could just rephrase the question, what do we need to see? What do we need to wait for you to be more, I guess, optimistic on the sector as a whole?
Well, I guess the breaks into the moving averages that I was also telling you earlier are something we'd like to see. But maybe another hurdle, by the way, which I thought while April was answering, which maybe was not yet discussed, was the presence of REITs. And because of that, its appearance, what happens is that you disperse the demand from people to buy, let's say, an Ayala land rather than a REIT. And if you buy the A-REIT, you're there directly off the returns that they would give you in terms of the yield on that. And if interest rates again are stuck at a high level, which is very much directly more competitive to that particular product, then you get a lot more people who are going to get locked up into that, or might not be able to shift back into a property stock. So I mean, that's another thing that's been quite a bit of a disruptor into the property stocks, because now you have to look at two to be able to, do I buy a REIT? Do I buy Ayala land? Which one and when? When do we make the timing? So you're going to have to make more definition in that, especially with rates being where they are today. So I think you really have to see rates come down.
Yeah. All right. Okay. So the next one. Okay. So what would your best sector that looks most promising for you guys for the second half of the year? April, you want to start, or if you're
Okay. So yeah. I still have a defensive sector preference right now, and of course I like the REITs. Yeah, and maybe a little bit of recovery on the properties probably. But okay, let me just answer that by saying which sector I'm not so keen about. I think
okay?
consumers, I'm a little bit worried because we're seeing the prices of a lot of soft commodities go up right now, and so that might lead to some margin pressure for consumer companies, the consumer manufacturers. So yeah, not too keen about consumer manufacturers. So with this rally, I wouldn't be buying them. Or with the recovery of the market, I wouldn't be buying them.
Okay. Juanis, your take?
Well, I think aside from the banks being looking more attractive on pullbacks, right now I have very neutral stance on most of the others, and that would force me to take up a more bottom-up approach rather than a sectoral approach. So I will look at issues that are doing better than one than the other, and I will concentrate on that. Like, for example, if I were to look at a telco sector or services, I will see that maybe Global doing a little better, ICTS doing a little better in terms of services. I'll focus there rather than ones that are not seemingly picking up. Or even in banks, then again, I will concentrate on those that are stronger, which will be BDO and BPI, where Metro Bank clearly is a laggard for some reason. And I will not be moving that way. So I will have to take a bottom up. I'll look which one is doing better than the other. Not so much on the sector, although clearly the banks, I think, will still show some activity once a pullback takes place.
All right. Okay, next one. So, okay, of course we can't go ahead with a briefing without talking about MPI. So, what are the chances that? Sorry. With the current tender offer of 520, do you feel? I mean, what are the chances that people would finally push through, and investors would accept the tender offer?
Of course, the chance I think would be greater compared to their first price. But I guess as I've said before, it really depends on the government financial institution, because I think combined, for example, the GSIS and SSS together have more than 5%. I don't know if they will be required to be able to get to bring the free float down to below 5% for them to delist, or if the PSE will allow them to delist if the free float goes below 10%. No? Yeah. So, but it really depends on. I think if the SSS and GSIS, SSS will say no and will not accept the tender offer, then there will be no tender offer and privatization.
I guess more importantly, so we often say this, and a lot of clients ask us. I guess as retail investors, more importantly, we all often advise them to just accept the tender offer if you have it, and if they don't get the necessary number of shares, they're gonna return your MPI shares anyway, right? So do you agree with that recommendation, especially for those who cannot risk getting delisted, right? Because it's of course a pain, right?
Yeah, it is a hassle to be owning a privately owned company, especially if you only own a few thousand pesos worth of it anyway. So unfortunately, being minority shareholders, that's the risk. So we don't have a choice but to just accept it. No.
Okay, so let's go to the next one. Okay, on the individual stocks, opinion on Bloom. So I think Juanis briefly mentioned this a
I
while
gave
ago.
it earlier.
Yeah. Go ahead, sir.
Yeah, I mentioned this earlier. I think the play on Bloom really is on the tantamount situation where MPI would be delisted and Bloom would be a strong candidate to be included as an index member. And that's why it's had some relatively good standing in terms of interest. And I guess the only thing we watch out for is if MPI tender does not happen, then you might see. So you may have to stay glued into how things are feeling towards the MPI meeting and whether they seem to be on track to be able to get everybody to be able to tender the shares. Because if it doesn't push through, there could be a rude awakening for Bloomberg.
April, like on the fundamentals of
Yeah.
Bloom, what
Yeah, yeah, fundamentally okay naman. The earnings are quite healthy, and that's just for Philippine-based clients. They're not seeing the foreign clients coming in yet. But then again, the question is, what is the catalyst for Bloom's strength recently? And if it's MPI, unfortunately, yun na nga, if the MPI privatization doesn't happen, there might be a short-term sell-off of Bloom if that was the catalyst. No, madi-disappoint yung investors.
Okay, so all right. So I think I'll skip the last one. I think both of you already briefly talked about SEC. So in the interest of time, I'm gonna skip that one and go to the live questions now. So can we see the first live question that we have? Okay, so with the looming recession in the US, what would be the best investment mix for cash, fixed income, and equity from Jonathan? So April, you want to start?
Yeah, I think it depends on what your historical asset mix
Allocation.
is, but yeah, your asset allocation is. But I thought about this. Kung ganon, why not buy equities na lang? But yun na nga, I cannot not buy equities because they're so cheap. So it's more of a barbell strategy, if you ask me. Yeah, I like fixed income, but then equities are just so cheap to the point that I can't just ignore it. And of course, Philippines, that said, we did the bull bear cycle. It's already in the late stages. I mean, if US equities, probably I'd say, yeah, you should lighten significantly. But for equities in the Philippines, maybe, not super overweight, but at least buy some, and then from your say equities pie, reduce it a little bit and allocate some cash.
All right. Juanis, do you want to add anything on this
No,
one?
that's fine. I think
Okay.
April also showed a slide in her presentation
Yeah.
that also did a breakdown. So I think that's fine.
Okay, next question, please. Can we have the next question? Apart from liquidity advantages, is it practically better to invest in REITs? Do you want me to take this one? Okay. Sige, majority of REITs and recent IPOs have been so underwhelming and lower than their starting price. It feels like the market is just grabbing the public's hard-earned money. Any signs for a turnaround from Mark? A very interesting question. So, April, what are your thoughts? Or honest, if you want.
What a very pessimistic way of looking at it. Hindi naman siguro. But any signs of a turnaround for what? The market? Well, I think we kind of talked about our outlook anyway. Well, that is the hope eventually that we will have a turnaround of the market, because I think yun na nga, if the economy remains healthy, earnings should recover, and valuation should go up. I think it's quite unfortunate that we are in the condition that we are, but you have to remember that this is not normal. The cheap valuations, the lack of interest is not normal conditions. But, niloloko ba tayo ng mga companies? I don't think so, in the sense that, okay, like the current valuations, they don't like it either. Which is why, so many anecdotal signs why that prices of stocks are so cheap right now. For example, the MPI privatization. That's why they want to privatize the company because it's so cheap. And they're not the only ones. We had Eagle privatizing, Wholesome trying to privatize. And then we have a lot of private deals that are priced at a premium to the market price, diba? So those are just signs that, the valuations we're seeing right now are unusually cheap. And it's not because the companies are trying to take advantage of the public. But eventually things should turn around. This is not normal. The current times are not normal, and eventually we should recover.
Juanis, do you wanna?
Well, maybe the only thing I can add is, it's very tendency. People are most bullish at the high, and people are most pessimistic at the low. This just adds more flavor to the bottoming out scenario.
Yeah, all right. Well, I think that's well said. Can we go to the next question? For Sir Juanis, what's the direction that PLDT, the TEL, will go given its positive outlook with the PSEI? I'm not from Patrick.
I think eventually PLDT will make a resumption of its recovery, although it's still kind of sideways right now. But like I pointed out, it was actually very early in its ability to show a turnaround potential, but it stopped there and started just moving sideways. I guess that's a danger that I'm talking about into a bearish swing, right? You might have the ability to be able to rally towards the first stage, then you park there for a very long time, and then you're waiting for catalysts to come back inside. And if none come out, then you just linger, right? And so in the case of PLDT, you're just lingering and waiting for something to be able to happen. And I think once more issues start to show that they are on a recovery streak, I don't see why PLDT shouldn't move on along with the rest. So if I have it, I would just hold it.
All right. Okay. Next question. Question for April. Where are we in terms of earning cycles in Philippine companies? Are sector earnings trending up or down for next year, for 2024, from Trisha?
Yeah, I think still trending higher. The problem is the level of growth might not be as strong as we saw last year, because remember, in 2022 we had the benefit of low base effects coming from the pandemic in 21. So 2023, the comparison for 2022 is not as low anymore. So yeah, I think still up, but not as strong as the 22 growth that we saw, no? And of course, meron ng mga certain headwinds that could affect the magnitude of growth. For example, GDP growth this year projected to be 5.5%. Diba? Last year, I think we were 7.4. So normally in the past, we were doing, say, 6-ish% GDP growth. So that said, mga 5.5 is not the strongest, but it's not weak either. So I would say something like that.
Yeah. All right. Next question. Apart from liquidity advantages, is it practically better to invest in REITs than buying a property for the long term? From Samuel. Okay, so REITs over the actual real estate or actual property. April, your thoughts?
Yeah. There are some advantages because, okay, for rental properties, syempre, wala kang diversification, then you have to work on it. If you just sit on your property, you're not gonna get it rented out. You're not gonna get income. Then you have to pay dues. You have to, all the hassles of it. So in that respect, yeah, maybe REITs are better. But that said, I mean, it depends, no? I think more of if you're after liquidity or income producing assets. Okay. Kasi pag if you're after capital appreciation potential, I'm not so sure that the REITs can give you that. Maybe buying land would be better, in that respect, diba?
Yeah. I think if I may add, no, I think the advantage of the advantage is more like psychological, because REITs are mark to market, so you see the share price going down. But property, as long as you don't sell it, you don't really realize the mark to market drop. And maybe another thing, again, psychological, is that the property, you could see it, you could literally stay there, right? So yeah, maybe that's one advantage of the property.
And also think about it. Okay, if you own a REIT and then nag-volatile siya, sabi mo bentahin ko na lang. But if you buy property, you're ipet, diba? So that means that you're forced to own it for the next 10, 20 years. When you see the prices, they've gone up and somebody actually bids to buy it, no? Whereas the REIT, you see it every day. So if you need money, then it's the easiest thing to sell. So probably you won't own it that long.
Yeah. Okay, so I think we could go to the next one. Next question, please. On a bull run, when is the right timing to trade second liners? And how do we choose which stocks? From Jesus, Juanis.
In a bull run, you just buy anything.
Whether first, second, or
there
third.
is no such thing as choosing. It becomes holding power now becomes the question, because sometimes there's a tendency for you to try. You're so good with the gains, you sell it, then continues to move higher, then you try to buy it back at a higher price. Then when it corrects, and that's where problems begin. So, right timing in a bull run is not hard. You can just buy whatever you want. Now we're talking about third liners. That might be a little different, but second liners will move just as strong, if not stronger, than the first.
All right. So in a bull run, the timing or the holding part is more important than the actual differentiation.
That's correct.
So any thoughts on the impact of El Nino to the PSE from Francis? So April?
Yeah, okay. So the impact of El Nino will depend on how it will affect the prices of commodities, especially food commodities, because the Philippines is more sensitive to the prices of food on inflation. So if food prices go up, that could lead to higher inflation. And of course, higher inflation could result to higher interest rates. And aside from that, of course, higher food prices could lead to weaker margins for our consumer companies. So those are the potential threats brought about by El Nino.
So how concerned are you, I guess, as a follow-up? Of course, it's a concern, but how concerned are you, I guess?
I'm a little concerned, but we cannot be too pessimistic because there are so many threats naman talaga, diba?
Yeah.
So what I do, if you are so concerned about El Nino, is to monitor the prices of mga soft commodities and to see how much they've increased relative to, say, last year, no? To see if it really is that much of a threat, no? Or pwede naman kasi slight increase lang eh. So I guess that's something that is still acceptable.
Okay. Next slide, please. We have more questions. How about the energy sector? The energy stocks are dwindling despite the renewable energy emerging in the society. So from Shirley. So I guess she's referring to like
ASEN,
AP
probably.
recently, but even AP declined recently. So ASEN, I think those two in particular. So what are your thoughts on why are they, I guess, going down despite the power situation that you talked about a while ago?
Yeah, I think AP may be correcting lang. Doesn't change my mind. ASEN, it's probably because, okay, if there is a yun na nga, in general, I think Juanis has shown that the prices of the mga fuels such as oil, coal are still weak. And if that were the case, then the urgency to adopt renewable energy is not there. Kasi syempre mura eh. Mura naman pagka mag-coal plant ako or ano. So why am I going to hurry up and, buy renewables? Or hindi siya uso. Ganon. So that's why that is the main concern. You have to wait until, prices of these fuels or fossil fuels are starting to go up again. Then that's the time when people are going to say, oh, we need to think about renewables because renewables don't need expensive fuel to run, diba? So yeah, so that's what you have to look at.
All right. Okay. Next question. Maybe we can take one or two more before we end. For Ma'am April, could you please advise what are the US 10 leading indicators from CESA?
Okay. Well, I have to take a look at that pa. Pero ang sure ko, for example, I think the stock market is there, probably mga interest rates like yung the yield spreads and I think on the employment side, they don't use unemployment eh. What they use is hours worked per week, average hours worked per week. Yeah, and the initial jobless claims, no. So yun yung mga indicators that I'm sure of that are part of it.
Okay. So I think we can have our last question. We're past our schedule already. So last question for our speakers. How about Pure Gold and Monde? Any insight from Edwin? So quickly, April and Juanis, thoughts on Pure Gold and Monde?
Yeah, I think Pure Gold is okay naman. The earnings have been okay. And well, if the peso continues to strengthen, that should be good for their SNR business. For Monde, well, there are some positives for Monde, no, not saying that it's all negative. One of the things that they have done, or one of the mistakes they've done, is they locked in expensive raw materials, but these raw materials are already being depleted, so now they can take advantage of the lower commodity prices. Unfortunately, again, commodity prices are showing signs of, going up again because of El Nino. Hopefully, it doesn't last. And then the other issue is corn. Well, it looks like corn will remain weak. The meat alternatives business will remain weak because Monde shared that inflation in the UK remains elevated, and as the UK economy remains weak, people are not prioritizing the purchase of, mga alternatives. They're more focused on buying their essentials or what they're used to. And right now, in fact, because food inflation in UK is so high, people are shifting to starches such as noodles now and bread because it's cheaper, no? So yun. But that said, valuations of Monde have gone down, and then maybe earnings are showing signs of a recovery. But yun na nga, the ability to go up substantially might still be, I guess, capped by the other threats that they're still encountering at this point.
Okay, Juanis, quick thoughts on these two?
Both of them are both in corrective channels, and they have not broken out, but both of them are showing some interim rallies right now. So I'm looking for Monde. Next resistance is closer to 10 and 11. So I really hope that we can show some rally there so that some can take some off the table once it gets there. With regards to Pure Gold, not so far away. It's between 31 and 32 as the next resistance. So that will be the area that I would look to take some profit or to lighten on a position that I must. But both of them are still on downtrending angles right now.
Okay. So I'd like to ask both of you, April and Juanis, your closing thoughts before we end today's webinar. So April, do you want to start?
Yeah, okay. I guess, yesterday we kind of talked about this. Am I bullish, bearish? Well, for me, it's more of I'm bullish, but of course, I see some possible issues that might lead to volatility in the short term. But that said, if the market goes down because of these factors that would result to some volatility, I think it is an opportunity to actually, buy shares and to keep them for the long run, because I feel that we are in the tail end of the bear market cycle, and this is a great opportunity to actually accumulate stocks for the next stage of the cycle, which of course after a bear market comes a bull market. So now is the best time to actually accumulate stocks.
Okay. Well said. No, very clear, very clear. And yes, you're bullish. Okay, honest. What about you?
You seem very surprised.
No, I'm not. Go ahead, sir.
Well, I guess I'd share the same sentiment. We've been waiting for such a long time already, and we see that prices are now trying to be able to stage a comeback, be it a slow one. And we may have to be able to put our thinking caps on, because we may have to attack this on a very selective basis for the meantime until better momentum can come in. But as we presented to you, we are on the tail end of a bear market, if not already the bottom. And now it just needs the market to be able to anchor itself well and deal with a little bit more of headwinds that are there. But I feel quite confident that the picking up of good stocks at attractive prices, looking for setups and letting them go, trying to keep your positions intact and only selling it maybe just a portion of which is probably the adjustments we're going to have to make here, because we're not in a bull market sweet spot just yet. We're coming out of a bear market, and since you're in transition, your ability to come to the market should also transition from very bearish to eventually building your positions into equities once again. And as the market intensifies, then you can also intensify your position there. But keep your eyes open already for the opportunities at hand.
All right. So if on my end, also please spare me a couple more minutes. Right, I just like to summarize everything to the best of my ability. So if you can have my slides, my one slide, right? So if I were to summarize everything, so I guess it's optimistic, but with reservations, right? So optimistic, but with reservations, right? So we think that the markets, despite the weakness that we've seen the last few months, is still on track, is still setting up nicely for the next upswing, or for the next sustained upswing. So we're still in the normal process of that bottoming out, right? Both fundamentally and technically. Fundamentally, April mentioned that Philippines is still very attractive, a resilient economy, declining inflation, the recent strength of the peso, and of course the undemanding valuations. And then technically also, Juanis mentioned how this is again the normal part of the bottoming out of the bottoming out process. And then both of them, they talked about how we're already most likely towards the tail end of that market reversal, or that bottoming out process. No, but nevertheless, okay, despite that optimistic, I guess, view, short-term headwinds are still present, right? Both again, fundamentally and technically. Fundamentally, April talked about how the US could face near-term weakness, both in terms of the economy and the share price, and that might cause a short-term decline in the local stock market. But please be reminded that that should be viewed as an opportunity to buy. And then also April briefly mentioned about having the lack of catalyst, right? So maybe we need to continue to look out for interest rates going down, right? In terms of technicals, again, the key resistance area that Juanis mentioned is the 6750, which would be the third confirmation of the reversal, the continuation of the reversal process, right? But until then, we're still stuck in the sideways trend. There's still some headwinds that we need to face, right? So we cannot be too aggressive yet as of the moment. Okay, so what do we do, right? So continue to exercise caution for the meantime, but be ready when conditions improve, right? So as a trader, don't chase prices, buy closer to support, look to, take some profits if you see significant or meaningful rallies, right? As an investor, stay invested, but at the same time, keep some dry powder and do not be scared when that final sell-off, if ever it does come, do not be scared, right? So more importantly, we have to stay ready because as Juanis mentioned a while ago, at the end of the bear market or the bear market stage would be the beginning of the bull market. And hopefully all of you guys here will be prepared when that day eventually comes. Okay, so let's thank April and Juanis again. So thank you, April and Juanis, for spending your Saturday morning with us. If you guys want to follow their views more regularly, you can always access their reports. April's Calling the Shots report and Juanis's Tech Spotlight on the website. All right. So thank you also to everyone who attended here today and spending your morning here with us. Enjoy the rest of your weekend and hope to see you soon.